Hey, investors! Have you ever wondered if you could outsmart the stock market by following the moves of company insiders? You know, the CEOs, CFOs, and bigwigs who know their companies inside out? Can an insider portfolio beat the market? Today, we're diving into whether an insider portfolio can really beat the market. Spoiler alert, the research says it's possible, but it's not easy. Stick around to learn how it works, what the studies show, and tips to make it work for you. Let's get started. If you're new here, hit that subscribe button and ring the bell so you don't miss more investing tips. First, what's an insider portfolio? It's when you build your investments based on publicly reported trades by company insiders. Think executives, directors, or major shareholders. These folks often know things about their company's future that we don't. When they buy or sell stock, they have to report it to the SEC, and we can use that info legally. Cool, right? For example, if a CEO buys $1 million of their company's stock, it might signal they think the price is going up. But here's the big question. Can following these trades actually beat the market, like the S&P 500? Let's talk research. Studies show insider portfolios can outperform the market, sometimes by a lot. A 2024 study from Michigan Ross found insiders beat the market by up to 20% annually by making smart trades. Another source, BBAE, says insiders have historically outperformed by about 11% per year. That's huge compared to the S&P 500's average of around 10%. But here's the catch. Not every insider trade is a winner. Research from Investopedia says only about 25% of insider buys lead to abnormal returns, meaning returns above the market average. So, while the potential is there, it's not a guarantee. Why? Well, insiders might sell for personal reasons, like paying for a new yacht or diversifying their portfolio, not because they think the stock's going down. So, the data says yes, you can beat the market, but you've got to be smart about it. Now, before you rush to copy every insider trade, let's talk challenges. First, the market is efficient. That means stock prices often reflect public info, like insider trades, pretty quickly. By the time you act, the edge might be gone. Second, not all trades are signals. A single insider buying might just be a one-off. Research suggests looking for patterns, like 3 or more insiders buying, to spot real trends. Plus, new SEC rules in 2023 tightened up insider trading plans, so the signals might be noisier now. You've got to do your homework. So can an insider portfolio beat the market? The research says yes, it's possible, with potential returns of 11% to 20% annually. But it's not easy. Only a quarter of trades really pay off, and you've got to overcome market efficiency and regulatory changes. That's it for today's deep dive into insider portfolios. What do you think? Would you try this strategy? Drop a comment below and let me know. If you found this helpful, give it a thumbs up, share it with your investing buddies, and subscribe for more tips to grow your wealth.